Alrighty then.
3, 2, 1. Magic time.
We're up. Okay.
We're up, we're down. I'm up, he sees me, I'm down.
I don't even want to even reminisce about that anymore. After the next, what do we say? 11 more potential
work days.
Work days.
Just talking about it.
Good night. All right. Yeah.
What
it felt
wisdom?
like, dude, it felt like a crazy week on the market. As it turned out, actually, it wasn't.
Not even counting St. Patty's Day.
Yeah. I mean, it's going to be interesting because I got a slide in here that shows last weekend's S&P 500 C fund and some of the things that we talked about, and what a difference a week makes.
What a difference a week makes.
It's going to be actually we'll get to it. It's going to be kind of interesting. It's not like we foretold the market rolling over this week,
right?
But we definitely sort of alluded to it and we'll get to it because it was volume.
We've been talking about it for 3 or 4 weeks.
Well, I mean, it's volume, right? So I'm going to get to the chart. But if you remember last week, we were talking about it. I'm like, this is an awesome chart. The C fund, hit new intraday highs and all that. But the only negative of that chart was that the volume was decreasing every day as the price was increasing. Mm-hmm. And we showed that that same thing happened in early February, and the market rolled over. And so I was like, I'm a little cautious because I'm seeing the same kind of setup, and that's what happened this week. I mean, the market rolled over.
Bingo.
It just, yeah. I mean, that's actually a good example of, timing the market, quote unquote, timing the market. If we didn't have 2 moves a month, I would have gotten out last Friday because that setup was exactly the same. But just because the setup is the same, the rules in TSP. To have to take them into account with this stuff makes it really difficult.
It really ties our hands a lot of times.
Yeah. So, but we're going to get to it. All right. We're going to stick with...
Did you learn how to pronounce this guy's name yet?
No. Lefebvre.
If anyone
is
French, please let us know. It's an awesome book. I'm halfway through.
Oh, it's a great book. Right? I'm glad you bought it. It's a good book. This is a little bit sexist, and I don't have to worry about it because I'm not trying to be... Miss Vogue magazine or whatever. What was her name that just got?
Oh, I have no clue.
You haven't seen that?
If you're talking about anything in Vogue magazine, I don't know, man.
No, well, it was the news. I don't read Vogue. It wasn't Vogue. It was Miss. I don't know, something. It was some magazine, and this girl that. The
more we talk about it, probably the more we'll get in trouble.
Yeah, I don't care. I'm not getting in trouble. I say that. It would be funny if we did get in trouble. I don't know how we would, but in this day and age, it wouldn't surprise me. Somebody would figure out a way. Yeah, kick us off our own show. Fortunately, we are the board, so we don't have to worry about that. This girl. She was going to be the executive editor or something of like Teen Vogue or whatever. Mm-hmm. It just came out today or yesterday. She's 27 now, right? Mm. She did a tweet when she was 17.
Oh, I didn't know it had anything to do with the magazine. I know what you're talking about.
Yeah.
So I heard some girl got like being held accountable. It's almost like the comedian that had something like 15 years ago, and he said something stupid. And he's like, I was young and stupid.
Yeah. Yeah, and you can't apologize anymore. I mean, apparently, I don't know anything about this other than what I heard in the news today. But she apparently apologized and everything like way back. Mm-hmm. And
is all this a disclaimer for that one quote you're about to do?
Oh yeah, I kind of went down. I went sideways, but yeah, it kind of is. Yeah. So, and it's a quote. I didn't write this. This is a quote from 1930 something.
Oh, that book is wild too. The stuff he says in it because it's in the context of like 1920s.
Yeah. Oh yeah. It's a cool book. It's probably gonna get banned along with Dr. Seuss, but anyway, it takes a man a long time to learn all the lessons of all his mistakes. Right? So it takes a man. It takes a woman too. That's why. That's where I was
takes a person.
Yeah, it takes a person. It takes a person a long time to learn all the lessons of all, should have said his mistakes. They say there are 2 sides of everything, but there is only one side to the stock market. It's not the bull side. It's not the bear side. It's the right side. It took me a long time to get that general principle fixed firmly in my mind than it did most of the more technical phases of the game of stock speculation. We've talked about it before. The most important thing is not to be emotionally attached to what you think is going to happen. Right. So he doesn't care if the market's going up, down, or sideways. He just wants to be on the correct side of the trade. Right. So the way you get to be on the correct side of the trade isn't to guess which way it's going to go. It's to respond immediately when the market tells you what to do.
Right.
Right? Huge difference between a crystal ball and the ability to look at what's happening on the market and change when the market tells you to change.
And what's really amazing is that this guy and the people that were doing it with him, in the same time frame, they didn't have charts. Like
Right.
they had a tape.
Yeah.
And the tape is delayed, right? Because it's telegraph from New York to there. And they're having to do the math and charts in their head, right? I mean, I'm like, when you read the book, you could tell that this is the early days of technical analysis, right? And I loved it because he would talk about how he didn't really care about, and what we would call fundamental analysis now. He's like, I don't really care anything about the company.
Right.
I'm looking at the numbers, and I see patterns. And when the market does this, generally speaking, there's a high probability of X.
Right.
And so he figured out those patterns because he was a real good numbers guy. And but I mean, it's amazing.
It is amazing, and the progression was pretty funny. We've talked about it before, but when I was a kid, my dad used to get these books that they came every month, and I think they came from Dow Jones. I'm pretty sure it was from Dow Jones Company, but they were stock books, and they had all the S&P and the Dow and the NASDAQ, whatever, and you would flip through these pages and look at the charts that were printed. They're like, I think they were weekly charts, 2-year weekly charts. And you would just go through and circle the ones that you wanted to do follow up a little bit on. But there was no computers, there was no cell phone, there was no Apple, there was no Excel, there was none of that.
Yeah, you're looking at old charts.
Yeah, and making your own.
Right.
I mean, they had extra pages at the end that you could like plot and make your own charts and stuff. Right. I mean, it's those guys were super smart. I mean, they were doing the same things we're doing now with all this,
It's like the equivalent of working on an abacus.
Yeah, abacus. Pretty much.
Doing math on an abacus.
Anyway, yeah, I'm a big Jesse Livermore fan. So, and for anybody who's watching the show that didn't watch it last week we were talking about this book. So anyway, we're talking about Jesse Livermore. He was born in 1870, dies in 1940, starts investing at age 14. Lost and made millions by the time he was 30, and ultimately makes his fortune short selling the top of the market in 1929. So Reminiscences of a Stock Operator, definitely go read it. Okay, the market this week. It was a rough week for pretty much all the TSP funds. iFund was up a little bit, and it just seems like it was a lot more up and down than, at the end of the day, the C fund's down less than 1%. S fund is still getting hammered because as rates go up, the tech growth stocks are just getting clobbered. iFund, like we talked about last week, has different components than the C and the S fund. So the iFund is holding up a lot better than the tech-heavy, certainly S fund, and pretty tech-heavy C fund. And then the iFund continues the collapse, but we're going to talk a lot about the iFund here. So these are the 5 things we're going to do. I know we got a lot of new people in the group. We've had some people from the member-only call last week that asked for kind of a technical analysis 101, right? So Elliott Wave, technical analysis encompasses a lot of different things. Elliott Wave is something that we use a lot. So we're going to do Elliott Wave 101 and then apply that to the F fund because it's been collapsing in 5 waves. Then we're going to do moving average analysis because that is another part of technical analysis that we do a lot, moving averages, and apply that to AMRN, which is a stock that I bought a few months ago, and I showed the ups and downs of where I bought it and where I sold it, and I said I was going to come back and take a look at it. And I'm going to ask you guys what you think, if you think I should buy it here or not. And then we'll look at the TSP fund charts. Okay. This is the ideal complete Elliott Wave pattern. Okay. It almost never looks like this in real life, but a lot of times it comes really close. Once you understand how the pattern works, you can just look at charts and kind of see where you are in the pattern. Elliott Waves basically observes human fear and greed. That's why it's consistent and repeatable. So I've seen some questions about, hey, life is different now. Computers are faster, rates are changing, all this stuff is going on. Why does Elliott Wave still work? Because it's not it's charting fear and greed is the bottom line. It's charting human nature and fear and greed. And that's why. It works best on broad indexes. So the C fund and the Dow Jones and the NASDAQ, it works really well on. It will definitely work on Bitcoin and Tesla and, NASDAQ at the top in 2000. We talked a couple of weeks ago about Tesla. Chad wanted to know, should I buy more, or should I sell, or whatever? And I took a quick look at it, and I'm like, oh, dude, no, buy more.
Yeah.
I mean, it was clearly in a four leg, which we're gonna.
Well, the difference is just a reminder that individual stocks, and this is why Warren Buffett and everybody else in the world says stay with indexes, is individual stocks are more volatile.
Yeah.
So it's harder to see the pattern if you're not really, if you don't have a really good eye for it. Where with the indexes, because it's a broader group of, it's way easier to see.
Yeah.
You've got one data point with one stock.
Yeah.
And it's going all over the place. So you have to kind of be able to, and correct me if I'm wrong, it's the hard part is actually unseeing parts of it, like not looking at that part and recognizing the real pattern, right? Because it's not the pattern that confuses you; it's the other, it's the extra noise.
Sure, and that's the thing about individual stocks, right? Like, I mean, every time Elon tweets something,
right?
It's fundamental and social and whatever. Those things affect the stock price.
An individual stock.
Stocks, yeah, but the index is not so much.
No, it's really hard to when people make that stretch to say that, the news came out today of XYZ and it impacted the S&P 500, you're like, no, come on.
No, if the Fed says something, it might, but
maybe,
yeah. And that's not even always, because that was a big thing this week, right? The Fed came out, everybody was all freaked out about, I don't even know what, but the Fed was going to come out this week and say something, and it, you can't really see it in the chart. It was kind of a blip,
right.
So anyway, okay,
that's a perfect Elliott wave.
This is the ideal Elliott wave. Okay, so there are no times on here, right? You could call this 2009, because that's the last major low that we had. And so from our count of the Elliott wave pattern, like right now, we are somewhere like in here. Right? If you looked at a chart of the C fund, it's going along that kind of pattern, and we're in here somewhere, and we're, as we approach the top, we want to get out like in as close to the top as possible, which is why we have a lot of in and outs lately, because we know that we're much closer to a top than a bottom. And so if this is a long-term, one complete Elliott wave pattern, and this is 2009, I think it was 666 on the S&P is what was the low in 2009. And now we're up here at 3,400, more or less. So ideally, the ABC gets you down to roughly a 50% retracement. So, it's going to be a big move down when it happens. But the pattern can also be intraday or, day to day or weekly or whatever. But this is the ideal pattern. Okay. And the way the pattern works, it goes up for 3 and down for 2, which is your first leg is up, the third leg is up, and the fifth leg is up. The second corrects the first, move higher, and the fourth corrects the third, move higher. Okay, so that's your 1, 2, 3, 4, 5. Then you get an Then you get an ABC that corrects this long one. That's why the 5 is also a 1. Okay, and then the ABC is a 2. And then we go into the 3. So it's patterns within patterns. Okay. That's the way the ideal pattern looks. We only have 3 rules for Elliott waves. There's a whole bunch of guidelines, but there's only 3 rules. Okay? Rule number 1. Leg 2, which is this. So 2 cannot get below the beginning of 1. It wouldn't make any sense. It wouldn't. That's rule number one. Leg 2 can't get below the beginning of 1. Okay. Leg 4, so this leg cannot get below the top of 1. So leg 4 can't get to down here, or the pattern's invalid. Okay, that's the second rule. And the third rule is leg 3, which is almost always the longest leg. It doesn't have to be. That's not a rule. It doesn't have to be, but it usually is. Leg 3 cannot be the shortest impulse wave. And when the market's going up, when the overall pattern's going up, the impulse waves are 1, 3, and 5. Okay? Wave 3 cannot be the shortest impulse leg. That's it. 3 rules for Elliott Wave. Anything else is allowable. Okay? There's some guidelines. So when you look at this, the cool thing about this chart right here is it gives you the ideal extensions. So if you want to use Elliott Wave to try to kind of forecast where the market might top out, wave 1, okay, it's in this case they used unit 1, right, 1.00. Wave 2 ideally comes back 0.68, 0.62 I usually use, but 0.618% of wave 1. So 2/3, this move in wave 1, this distance, say it was $10. Wave 1 moved $10. Wave 2 takes away 2/3 of that $10, right? 0.618%. That's the ideal. Wave 3 is 1.618, okay, of wave 1. So if wave 1, in this case, is 1, wave 3 is 1.618. Okay? Wave 4 tends to be flatter. So wave 4 only retraces 1/3 of wave 3. So while wave 2 retraces 2/3 of wave 1, wave 4 only retraces 1/3 of wave 3. So in real life, I mean, on the ideal, what they drew here, it looks like wave 2 and wave 4 are kind of the same. In real life, what tends to happen is you get 1, 2, 3, 4, 5. Wave 2 tends to be much deeper than wave 4.
Yeah, that's generally how it ends up looking.
Yeah. And then wave 5, wave 5 can be very goofy because it doesn't have to extend in 5 legs. It doesn't even have to go above the top of 3. That's when it gets really weird. That's where you get double tops that roll over. And
yeah, it's where it can confuse you because it doesn't look like the pattern.
Right.
But again, it's almost, you have to unsee some things.
Yeah, right?
Yeah. And notice that, we got a double top, and okay, well, that would still make it a 5. It's okay.
Yep.
And for all the people in here that got lost as soon as you said 0.618, trust me, I've been there. I'm not a math guy. I do have a little bit of analyst training in me, but the principles are what you need to see, right? Understanding all that math helps. It makes it more specific, and you can really deep dive. Yeah. But just understanding that general pattern, you can see that in a chart pretty easily once you start looking for it. Yep. And it never really looks exactly like that.
It doesn't. And if you think about it, it's almost like waves on the beach, right? As you start, the waves are coming in, right, and then they retrace, and they come in. It's a little higher because the tide's coming in, right? So it goes a little bit higher up the beach, comes back again. Goes a little bit higher up the beach. Next time it comes up, it comes back down, and when it goes back up again, now it's not getting as high as it was before, and it comes back down. So now the tide's going out. It's just the way it works.
Leave it to a Navy guy to find
like
a water analogy. But I do like that. That's kind of the same theory, right?
It's the feel of it, right?
The wave coming in, and then it starts pulling out,
and then starts coming back.
It's a good one. We might have to do a little video like that.
Okay. This is actually really good if you do want to try to use it to project where you use it in coordination with a lot of other things. But if you can see that we came down here and we hit a bottom. And we came up 1, I counted ABC 2, we came up to 3, ABC 4, and I try to project how high the market will go, right? I know that the ideal is wave 5 is the same distance as wave 1. So that's a place to start anyway. Okay. Hopefully that wasn't too far over the heads of everybody for a Elliott Wave 101. But if you Google Elliott Waves, there's tons of information on there. And ElliottWaves.com is the absolute go-to. That's the Prechter's site. It's awesome. Okay. What does it look like in real life? So this is a 6-month chart of the F fund. What we got is we had a top here, right? Again, right now we're just looking at 6 months on the F fund. So we had some kind of churning, consolidating here, whatever, and then we get a top, right? So we had a big breakdown for the 1. We got an ABC for 2. Then within wave 3, we have 5 waves. 1, 2, 3, 4, 5, which gives us the 3. I'm pretty confident to that point on the F fund. I would have liked to have seen wave 4 that did like ABC. It would have been better if wave 4 was here. And then we started 1, 2, 3, 4, 5, and we got down to wave 5. That's what I would like to see. So it's a question in my mind right now whether or not this is actually wave 4 that's completed. But right now, it's my best probability. So whether we are at the bottom or we're still going to come down a little bit more, we're getting really close to a bottom at wave 5. So once we get to the bottom at wave 5, what do we get? ABC, right? So if this wave 5 becomes a 1 and this ABC becomes a 2, and we can keep going down like that, right? And that, strangely enough, looks just like that. So they're patterns within patterns. We'll see what happens as it progresses. So that's why I put out a chart a couple days ago. I didn't draw the Elliott Waves on there, but I put out this chart on Facebook to just kind of getting everybody looking at, we are close to, we're either at or close to a bottom there at 5. So when people are asking, does that mean we should get in the F fund now? No, because we don't know yet.
Let's confirm it.
Yeah, I want to see it confirmed. Now, again, if I could trade every day, would I throw a little bit of money in there and give it a percent or two to confirm whether or not it was going to be a bottom?
Absolutely.
Sure. That's not the game we're playing. I can't play that game.
Yeah. But explain confirming it just real quick so people understand that might not get it. So what we mean by that is it starts to get some support and comes back up, and you want to kind of let that play out. Then you know it's on its next leg, right?
Right. So that's kind of what these arrows are about right here. So you got the technical indicators down here, the relative strength, and the MACD. Okay. The relative strength is already starting to come higher because you got higher lows here on the MACD, even as the price is coming down. So that means the momentum for price decrease is decreasing. Okay, the momentum that's pulling prices lower is decreasing. So even though the prices are going lower, we are approaching a bottom. It might not be the final bottom, but we're approaching a bottom of some sort. Here's the 10-day moving average. If you really wanted to confirm it, as the 10-day moving average keeps coming down and the price starts going higher, pretty soon you're going to get a close above the 10-day moving average. I mean, that might be a good time to get back in the F fund, right? Especially if the RSI starts going up and the MACD starts going up.
Because then you have multiple indicators.
Yep.
Higher probability.
All these things layer on each other. The Elliott Wave is a great tool, but it's not the only tool.
Yeah, that's also a big takeaway, right, is that people understand that we definitely don't use one technical indicator as the powerhouse.
Right.
You kind of have like your 3 or 4 like kind of go-to, and then most technical analysts that I've seen so far have been you got your 4 or 5 kind of that you go to, right? And when they're all telling you the same thing, life's easy.
Yeah, you're in good shape.
Right. And it's when they're not that you sometimes you got to bring in some other things. Right. And so as long as they're all telling you this, the same thing, you've got a high probability. It's when they're a little bit confusing, then you got to bring in some other indicators. The good thing is there's quite a few.
Yes,
there's
definitely.
quite a few that we don't even talk about.
Oh yeah.
And that a lot of people in the Facebook group that we have use all the time.
Yep.
And it's really about which ones you understand.
Yep.
And which ones you have lots of experience with, so you can see that pattern really quickly and easily. Some indicators resonate with people faster.
Yeah, that's a great way to put it. There are tons of indicators, and yeah, the ones that you get, the ones that make sense to you as you're looking at the price chart, are the ones you use.
Yeah, and it's not to say that the ones we use are like the best ones.
No.
And we admit that fully when people kind of call us on it. We're like, well, you use the ones you want to use.
Use the one you want, yeah.
Yeah, well, this is the ones that we understand, and it kind of means something to us. And I mean, you'd be hard pressed to find something that replicates or is a complete solution than other than the Elliott Wave. Like that's hard to find, right? Yeah. But there's a lot of other kind of smaller indicators that definitely. Right. But Elliott Wave is one of the biggies, though.
The good thing about Elliott Wave is it tells you the direction of the overall trend. And I don't know how far you've gotten in the book. Now, did we talk about that last week? I think that was the quote from last week. Once Livermore figured out that he can, if he understands the direction of the overall trend, then his buying and selling individual things, it puts things in a much better perspective. Because you don't want to short the market when everything's going up. I mean, you might look at a stock that's like a perfect stock to short. The chart might look perfect, but if 9 stocks out of 10 are going up,
if the overall trend is going up, that's not a good.
Nah, you're like fighting City Hall or whatever. Like it's, you know what I mean? It's just not a good idea. All right, so that's how you would apply Elliott Wave to the 6-month chart of the F fund. Here's a 1-year chart of the F fund. So the perspective is a little bit different, right? The top that we were just talking about is right here. The actual top of the F fund, the all-time high top, was back here. So if I was looking at it from a bigger perspective, I'm saying this is 1, 2, and we're in a 3. So it didn't really change anything. From our purposes, we're still trading, if we were trading the F fund, in that time frame, because that time frame works within the TSP rules for us, and you can kind of see it right there. 1, 2, 3, 4, 5, right? And that might be the 3, and then we get an ABC 4, and then we get a 1, 2, 3, 4, 5. F fund obviously. Well, F fund is the biggest thing that affects the F fund is interest rates. So as interest rates continue to go higher, if they continue to go higher, we'll see some kind of consolidation, and then as rates go higher, the price will continue to go down. So if you're watching the news and you hear about interest rates are continuing to fall, that's what's going to happen on the F fund. But again, right now, the technical indicators look like we're looking for at least some kind of short-term bottom. Okay. So if we bring it out all the way on the F fund, and this is the last chart for the F fund, bring it out all the way, we did, it's either in Smart Reads or one of the posts in 2019. That breakout right there, we did a post on, because this triangle pattern was really, really good. I remember that breakout, and I remember talking about the reason. Like, I don't usually trade the F fund because this this pattern was an awesome example of that breakout out of that triangle, long-term triangle consolidation was a great example of a chart pattern. The problem for us is, even with this rate of ascent, which is unsustainable, right? It's going up really steep relative to the rest of the chart. You're only going from 100 to 115. That's a 15% move in all of 2019 and 2020. I mean, it's just not worth, compared to the C or the S fund, a 15% move over 2 years isn't worth it. And that's why I generally am not ever in the F fund. It's just that the example here is really good in terms of the chart. And the other thing that's good in terms of the chart is that looks like a pretty scary top to me. You got these are each tick here is a month, and it's an 18-year chart. So it's a really long-term chart. We've been overbought for a pretty long time, and we just crossed down, right? The RSI just went negative. MACD just went negative off of being way overbought. So in the big scheme of things, I would not be buying the F fund here. So even though I was saying we're looking at a short-term bottom here, the long-term chart does not look good at all. I mean, the next support level maybe is at 110 because we get some support there, but really down here the price could definitely come all the way back down here. All right. Okay, so number 2 was moving average analysis. I said that was the last chart for the F fund, but I lied. So this is the same chart we were looking at 6 months on the F fund, except now we got a 50-day moving average and a 10-day moving average. Okay, so the blue line is the 10-day, the red line is the 50-day. You got when the price is below, it tends to hit it and go lower. Hit it, okay, and then now it popped higher. This particular part is kind of oscillating back and forth along the 10-day, so it's not great. This is kind of doing the same thing. It's when it gets above the 10-day, it tends to stay there until it breaks down and goes below it. The hard part for us is if the 10-day and the 50-day are close together, then it might break through the 10-day and find support at the 50-day. In this case, it didn't, right? It broke through the 10-day right there, and on the same day, broke through the 50-day. And then what happened? It came down, came back up, hit the 50-day, couldn't get above it. Couldn't get above it. Now it can't even get above the 10-day. And it just keeps going until it doesn't. Until eventually the 10 days down here and we get a price close above it. Then we'll have a break in the trend and we'll either go sideways or go back up for a while. But that's like an overlay on top of the Elliott wave, right? And it supports it because we started here. Our 1 took us down below the 10 and the 50. The ABC took us back up. Couldn't hit resistance, couldn't get above the 50-day. And then the 1, 2, 3, 4, 5. Now we're below the 10-day consistently, and we're on a five wave down. So F fund is not looking good at all. That's how you use moving average lines, kind of in coordination with Elliott wave. Okay. Is that what I wanted? I thought I had one more. Hold on. Okay. A couple of things I wanted to talk about on this chart, though, because it came up in the Facebook group. We were talking about shorting, and we were also talking about head and shoulders a while ago. We got some consolidation here, right? And we get support right there. Tried to have a little run here, it didn't go. We got a little bit higher highs, right? It came back down to that same support level that we were at here. Came back up more or less the same as this high here. That is a really sloppy head and shoulders. But the way the important thing is that you're kind of directionless here. you get some buying, you get new highs, then your low comes down to the prior low there. Okay, that's when the setup really kind of begins. Because then you're looking at, if I get, it comes up and hit resistance there, which is roughly the same level as here. If it rolls over and breaks the neckline, breaks support at there, the probability of it going lower is giant, huge. That's like a perfect setup for a short. That day right there, I mean, that gap down, if you were watching it and you shorted it, and I'm sure the news was all about how rates were going higher that day and everything, that was an awesome short opportunity right there. And even the next day you had that huge gap down. So that's great. If you shorted it there, you made a lot of money. When do you cover your short? So shorting means you make money when the market's going down, right? Okay, how do I know when to cover my short? Well, if you got you got 1, 2, right? And then we said 1, 2, 3, 4, 5. I'm looking to cover my short in here somewhere because I'm saying we're looking at some kind of a short-term bottom.
Right.
So if I had shorted,
I'd be getting out.
I'd be covering my short right now, and this would all be profit. Yeah. And then if it went against me, if the market kept going lower, I would just be looking for a reason to short it again if I wanted to, but that's the idea. Okay. AMRN. I still don't know what the company does. Maybe I'll go back and figure that out at some point.
all this chart work, and you still haven't looked them up?
Nah. So let me see if I can remember how this went exactly. I do remember this part. I bought the stock here on that day, and I sold it as soon as it crossed the 10-day moving average on that day. And so back when when I did the original post, it was like, hey, when I sold, well, it was like $10, and I sold it at 8, which if I owned it at 10 and I sold it at 8, does that mean I took a 20% loss? Or do I look at it as I bought it down here at 550 and sold it at 8? I made like a 40% gain. So depending on how you look at it, it was a great trade or a horrible trade, but that's how I do it. And then once I sold it and it stayed below the 10-day, couldn't get back above it, broke down through the 50, got back above the 10-day here, and now it's testing it, right? Friday tested the 10-day moving average. So I said I was going to go back and buy it when it was in a position that made sense for me to buy. So my question is now the time to buy AMRN?
I was too busy looking it up to see what it was. I didn't know you were going to give me a pop quiz.
So we were just talking about how once it breaks the 10-day, went sideways, couldn't get above it, came down, got up here, and did get above it. So now we are above the 10-day moving average.
So we've confirmed a bottom.
Well, a bottom.
A bottom.
Right there. We got a bottom right there. We got back above the 10-day moving average right there. And over the last couple of days, it's rolled over. But on Friday, it definitely got support. It's kind of hard to see, but got support at the 10-day. So based on all the stuff we've talked about for however long, would you buy it?
I would, only because it's a company that started in Dublin, Ireland. And
ooh, that's a good reason.
And I would just say yes. And they basically make biopharmaceutical, and they concentrate on omega-3 fatty acids. Like,
I probably need some of that.
I was like, sounds like a good company.
Yeah.
See, I'm doing a little fundamental. But
that's fundamental.
Yeah, I'd buy.
Okay. I'm not buying it yet.
Well, it's because you're low risk than I am.
That's true. That is true.
I'd jump in there and test it out.
So here's my thing. I think it's going to go higher because this day shows that there are people that want to buy it up there above $7, above the 50-day moving average and up there a little bit above $7. There are people that want to buy it, and it was on big volume that day. Right? It reversed, but we know that there are people up there that want to buy it at that price. Okay? So that's a good sign. For me, Friday got support at the 10-day, but it did it on really, really low volume. Okay? So I want to see if it broke higher. I would be watching this at 9:30 on the dot on Monday, and if it gapped up on Monday, especially if it gapped up above, like above this high, whatever that closing high was, even if it gapped up and it didn't get above the 50-day, but if it got above that 692 50-day moving average, I would absolutely be back in. And I will. So I will watch it on Monday. I will buy it if it.
And this, folks, is why we use his analysis and not mine.
Well, I mean, if you buy it now,
but it's a good example of what we tell people all the time about the TSP, right? So maybe your risk tolerance is a little different.
Yep.
Right. There's nothing wrong with that. It's just that you're willing to take a little more risk, right? So the probability isn't as high until we know what Jerry was just talking about, right? Until we know a little more.
Yep.
But if you want to get ahead of that and you want to, again, this isn't guessing. It's just increasing your risk tolerance.
Sure. Yeah.
Right. So it's not the same as timing. It's not the same. There are indicators telling us what we just talked about.
Yeah.
If that's enough indicators for you and you're willing to risk a little bit more, now's the time to get in.
Yep. If
you are like, we want to be in the TSP because this is our retirement and this isn't, what we're talking about isn't this company, you might want to have a little higher risk tolerance, right? And say, let's let this play out.
Right.
Let's let it play out. Let's see what it does.
Yep.
You know, just like we were talking about with the F fund. Let's let that play out and see where it goes. Yep. The important part is that we're watching it and we know something is going to happen.
You have your lines in the sand. So let's say you looked at this and you bought it today, right? Because you were okay with that support level at the 10-day moving average and you bought it today. I'm not going to ask you. I'm going to give you the answer to the question. What you
and what I'm looking for.
What you would do is, if you bought it today at the end of the day at 6:46, right? Let's see if I can zoom this in. If you bought it today at 6:46, still can't see it. The 10-day moving average line is 6:36. Okay, if you bought it at 6:46, and on Monday it dropped below the 10-day moving average line, you would sell it.
Out.
Your risk is 10 cents.
Yeah, exactly. Now, remember, everybody, this is in an individual stock that we can get in and out on. It's not the TSP.
Not TSP.
And that's why my answer was different too, right? It's like, I'll jump in. I'll play. I'll play at that risk level, knowing that the worst thing that can happen is Monday morning I wake up, I see it dip back over the 10-day moving average. Yeah. But I tell you what, if it goes over the 50-day, I'm buying more.
Yeah, you're buying more, and you made way more than I did on the trade.
Right. You know, but the risk was high.
Yeah, higher than mine would have been. Yeah, for sure.
Yeah, but I'll sleep better because I can move in and out. Yeah. You know, as we know, that's not the case with TSP.
TSP.
Yeah, but I mean, most of the takeaway of this, just so nobody kind of loses track here, we're not really talking about that stock. What we're talking about is how we use these indicators, the technical analysis. Specifically, this time we're talking about Elliott Wave and moving averages. Those two things combined give you so much information. Yeah. Now you throw in RSI and MACD to kind of tell you, like
the momentum. Yeah.
That's a whole lot of information in really just four things.
Yeah.
Right.
Yeah. Yeah. The best is when all these line up.
Yeah. You
that's why we stack them like this.
Yeah. Exactly.
Okay.
And it's just obvious what's going to happen, or what's happening, not what's going to happen.
What's happening, yeah.
Yeah, what's happening.
My eraser's not happening. All right. Last thing. TSP stock funds, what happened this week? Okay. This was the C fund last week. We talked about this at the very beginning of the show. Last week, the C fund had hit an intraday all-time high right there. Had broken out above both the 50 and the 10-day moving averages there, and we got back into it, right? The MACD turned positive. RSI had turned positive. Everything looks good, except, like we talked about last week, the volume was decreasing as the price was increasing. It's a big red flag. And we talked about how volume is the second most important thing to price. So we don't want to make decisions based on volume. We want to make them based on price. But it's definitely something to keep an eye on. And so what happened? This week, we had the same thing. We were worried about this volume decrease. Much like in early February, we had this volume decrease as price was increasing. And then February, it rolled over. March went higher as volume was decreasing and rolled over. So, again, TSP makes it very difficult because you can look at this stuff and make really good decisions, but to then apply the TSP rules just makes it really hard. So anyway, this is where we are right now. C fund's not in horrible shape. This low was higher than that low. This high is higher than this high. So we're still in an uptrend, which is fine. Friday was a pretty scary day. Had a pretty good reversal, finished just a little bit down for the day, pretty much right on the 10-day moving average. We could definitely come down and hit the 50 again, and everything would still be fine. Really, this bottom, this low, if we get below that low, now everything has changed. But the C fund isn't looking that bad. S fund is a little bit different because this low is lower than that low. And now we got this high is lower than that high. It's a completely different chart than the C fund. Lower lows and lower highs are not good. So we got some support on Friday at the 50-day, and we closed right on the 10-day. We're kind of in no man's land. It's we're precipitously in the potential of seriously rolling over in the S fund. We're going to have to let it play out. And so what does that mean? If you are risk averse, I would not be in the S fund right now. You got a lower high. It's a giant red flag. If you're risk averse, I would not be in the S fund right now. Okay. I fund is actually holding up the best, and it's consistent with what we talked about last week. We talked about all the different components, and there was no tech in the top 10 holdings of the I fund. And so the I fund this week, didn't really see any of the declines that the other funds did. So we're still riding the 10-day moving average higher. We're probably going to get new all-time highs on the I fund next week. We will see. But the I fund is definitely it's not that it's doing so great, but it's outperforming the C and the S fund right now. Certainly on the chart. And the good thing here is you get some pretty big volume on that day that got resistance at the 10-day moving average. And you got RSI, or MACD anyway, moving higher. RSI doesn't look as good, but MACD looks pretty good. So that's how you apply moving average lines to TSP stock funds. And we did a giant deep dive into the F fund. And that's all I got. Questions?
I had to finish swallowing my drink before I could answer.
Sorry about that. That was my fault.
No, it's my timing. I was like, I really wanted that little bite of Jameson before we had finished. Yeah, and so, there are a few folks probably that have watched this, since we've been doing it, and we talk a lot about these things like Elliott Wave and the moving averages and RSI and MACD, and we're not going to stop talking about them because, it's the way we do this. It makes it hard to kind of go back 3 shows from or 5 shows ago and go figure that out. If we get a lot of questions about it, that means we've got a lot more interest, and we'll talk about it.
We'll do it. Yep.
Yeah. So because we've talked about Elliott Wave before.
Oh yeah.
The thing is, and I mention this, as often as I can, we are building a course out for our website so people can come there and kind of, there'll be a standard kind of, here's how some basic chart reading, here's long-term versus short-term analysis, right? So I always tell people who are just starting to look at charts, don't just look at the 3 month,
right?
Don't just look at the 6 month. If you look at the F fund that we just looked at, if you looked at those 3 or 4 charts that you did, particularly the 18-year chart, the 18-year chart looks great. I mean, it just goes up.
Yeah.
Right?
Yeah.
But when you zoom in, there's a lot that doesn't tell all the story, because there's a lot of places in there where you could have, you could have done better. So there's short-term versus long-term analysis. There's, kind of big, I would say big analysis tools like Elliott Wave, and then there's kind of accessory analyst tools like RSI, MACD, right? And so learning how to use all those together, learning how to have a zoom in and a zoom out.
The time frame is critical.
Right? Yeah. And kind of getting used to that. Once you kind of grasp all that, you really can spend 10, 15 minutes a day. Yeah. And you got all this. Because we only have 5, right? Yeah. I mean, really, we only have 3.
Yeah. You're either in the stocks or you're not in the stocks.
Exactly. So it's not like you got to watch the G fund, right? So kept that one out. Yeah. But this isn't like having to watch the whole stock market. No. So if you just kind of take the time and kind of soak in this stuff, it really is. And then, what we hope is the value, our members see is they start learning how to do this, but you've always got kind of what we're doing as a validator. Yeah. Right. That's the idea behind our service, is not only to educate you, primarily it's to educate people, but the backstop is, okay, I think I did the math problem right. It's like going, you're in high school, you're like, I think I did it right. And then the teacher says, this is how you would have done it. Okay, now I did get the right answer, right. Or I feel better about my answer.
Yeah.
Yeah.
Absolutely.
Hope that makes sense to folks.
I think next week we're going to do, because we haven't done it in a while, is at least go back to 2009 and do the Elliott Wave chart from the last major low, which was 2009. And I'll probably actually go back to the really long-term chart from the bottom in 1932.
That's when you were in high school.
Yeah. Me and Lefebvre.
Edwin.
Edwin. Me and Jesse Livermore. It's very clear. You have to use the Dow because the S&P didn't exist back then, but you use the Dow Jones Industrial Average and you can see the 5 waves play out and how they played out over the course of the last 100 years, basically. And you can see where we are now within the bigger overall pattern. And you can sort of get a sense of why I don't want to, I'm very risk averse, because I know we are much closer to a major top than we are a bottom.
Than anything else.
Yeah. So at some point, we're going to have a giant correction. A giant meaning, from 2000 to 2002 was a 50% loss. That's a big correction.
And we don't want to be in there.
You don't want to be in the phones.
If you want to be in there, do your buy and hold.
Yeah.
I don't want to be there.
No.
Especially if, particularly if you're just now coming in, great, time's on your side. And we say that all the time. That's one of the biggest things. Time is on your side. If you're mid-career, late career, you certainly don't want to take that.
Yeah, you can't absorb
time's not on your side.
Loss, right.
I don't want to absorb a 20% loss.
Right, I know.
Right? I know. I mean, that's a boat.
I mean, I don't like, right?
That's a boat, man.
I don't like taking these 2 or 3.
Harley.
Yeah. I don't like taking a 2 or 3% loss a week. If I get out, the market broke below the 10-day or the 50-day, and I get out, and it turned back around and went up, and I get back in, and I took a little bit of loss there, I'm fine with that, because I know that mentality is going to keep me from taking a 50% loss,
And everybody asks us about performance, and yes, we're still working on the performance page. Yeah. We're trying to find somebody to help us make it better. But here's the point, is you can definitely go back and look at some of the posts that we've done, and we've missed those. Yeah. We didn't take the 50% and the 20-some%. We didn't take those losses. And that's just not us. That's everybody that was following. Yeah. And it's because we're risk averse. Yeah. If we weren't so risk averse, we might have taken some of that. Because some of it happens so quickly, you can't
Yeah,
you got to be
out. It goes
out.
down fast. It does.
You got to be out, and that's another thing that we kind of get dinged on from people sometimes that want to kind of play the devil's advocate, and it's like, well, you could have stayed in a little longer. It also could all happen within 2 days.
Yeah,
right, all of it, and then you're taking that day's closing price, whether you like it or not.
Yep.
We're making a move before noon, and I'm taking that day. So no, I'd rather just be out and sleep better. And
it's not that we're always risk averse. Like we talked about, our buddy there that wanted to buy Tesla, and I'm like, no, dude, pile in.
Yeah,
it's in the chart.
But it's the flip side of that.
It's the flip side of that. Yeah,
that's not being risk averse. It's like, no, that says the high probability is this.
You know what's going to happen, right? And whenever this,
I don't know what's going to happen. What's going to happen?
I can tell you what's going to happen. I just can't tell you when. At some point, we're going to have a giant correction, and we're going to come down. Maybe it's the 38% Fibonacci retracement. Maybe it's the 50%. I mean, who knows? But at those Fibonacci retracement lines, we're going to get back in.
Right.
I mean, and then we might get out because if it blows through that line, we get out. And so we took a little bit of a loss there. At some point, it's going to hit a Fibonacci retracement level, and it's going to be the bottom.
Yep.
And we're going to
jump back in. Yeah. All right, guys. Hopefully you enjoyed this show. If you did, share it with your friends. Throw us some comments in there. Give us some love.
Or give us some hate. We're used to that, too.
Yeah, we're getting used to that. We're getting so many people that watch this that you got to have the haters. And trust me, we don't lose sleep over it.
Yeah.
I don't. All right, guys. Hope you have a great weekend. Tell your friends we come out every Sunday at 6:30 on the Facebook page and 6:45-ish on YouTube. And let's just call it a day.
We're out.
Boom.
Cheers.
A little louder than that. There we go.